Hey, it's Mike Hambright with FlipNerd.com. Welcome back for another exciting, incredible expert interview where I interview successful real estate investing pros and entrepreneurs in our industry. Today, I'm joined by Arnie Abramson. He's a friend of mine. We're actually both Texans here. Arnie's been a real estate investor for around 25 years and really quickly found his way into buying houses at the tax sale. And Arnie's also been a landlord, a speaker, a mentor, an educator, and a number of things, very well known in our industry. But he's probably most well known for his knowledge with tax and deed sales, especially tax sales in Texas. In fact, we call him the sheriff. So today we're going to talk about how to be successful with tax liens and tax deeds with Arnie Abramson. Before we get started, though, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days with rates starting as low as 9%. For more information, call 888-296-1697 or visit RealtyMogul.com/flipnerd. B2R Finance makes loans tailored specifically for rental investors. They can help you unlock equity from existing properties so you can get cash out to grow your rental portfolio. That's huge, and it opens up lots of opportunities previously not available to rental investors. Need a rental loan? Call 855-819-4412 or visit b2rfinance.com. Virtual Staff Now is your source for done-for-you virtual assistants that specialize in helping you run your real estate investing business. They recruit, manage, and train VAs for you so you can focus on growing your business. Visit virtualstaffnow.com to learn more. We'd also like to thank Colony American Finance, National Real Estate Insurance Group, and Mid-Atlantic IRA. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of FlipNerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Hey, Arnie, good to see you.
Thank you. Thank you. It's a pleasure to be back.
Yeah, welcome back to the show. That's right. You were on almost 190 or so episodes ago, so very happy to have you back. And to be honest, we've seen a lot of interest in learning more about tax sales and stuff, so happy to have you back and talk about it again.
Well, thank you very much. It's been an interesting time since I was here last.
Yeah.
A lot of changes.
Yeah. Before we get started, Arnie, I'm talking about tax liens and tax deeds and your area of expertise. Why don't you kind of tell us how you got started in real estate investing? Because I know you didn't start in real estate. I know you found your way there like many of us. So kind of tell us the story.
In my former life, I was a financial planner. And when I moved out of that, I kind of reflected back that the best investments I saw overall in my career was real estate. And at one point in the former life, I worked for a company that syndicated limited partnerships in real estate on a national basis. And I was a regional guy, would go around to the brokerage firms and put on seminars to teach them about it and talk to their clients. So in 1990, when I moved to Dallas, I got involved in real estate, and I ran into a guy who had just moved to Dallas from San Antonio who had a lot of experience in tax sales, but had moved here to get in the .com business and didn't have the time. I had the time and didn't exactly know what to do. So we partnered up and we did a joint venture. And over the next 12 months, first 12 months, we bought 10 properties. So I actually learned by having someone that mentored me.
Okay.
And that was really great. I remember at one point he told me, one day you're going to outgrow this deal and you'll do it on your own. I said, oh, no, I'm too dependent on you. But he was right. We did.
Yeah.
And went on to other things. Now, that was back before there was a lot of information on the internet about tax sales. So we could really, at that point, only work one county, and it was Dallas. And after a while, that market kind of deteriorated. We had a lot of out-of-state investors coming in and bidding up the prices. And so we stopped doing it, but I stayed in the foreclosure business. I started doing HUD foreclosures, and I did VA foreclosures, and over the years just became a buy and hold type of person. When in 2007, 2008, when we started seeing the changes in the market, that's when I kind of said, you know what, it's going to be time to get back involved in the tax sales.
Yeah.
Because the way this is going, that's going to be a great market, because there are going to be a lot of tax foreclosures. And so I started rededicating myself and went back in to re-educate and see what the changes were, and to get more involved in it. And what I started doing at first was just to teach people how to do it.
Yeah.
But it was so complicated and so much work, and most of the people wouldn't do the work. So the next step I took was I said, okay, I'll mentor you. I'll take you by the hand. And they still wouldn't do all the work, because there's so many disappointments. You know, you even on just one county, you look at 100 properties, you get them narrowed down to 3 or 4 properties that hey, I'd take any one of these if I can go to the auction and get them. And none of them wind up going to the sale because they're paid off at the last minute. And it's very disappointing and frustrating. A lot of people got turned. So the next step we did was we said, here's what we'll do. We'll do all the work, and you can pay us if you're successful. And that's when it really took off. And we eventually became doing a complete turnkey program. So that's kind of how we.
So talk a little bit about, you talked about how in 2007, 2008, you saw the opportunity to jump back into tax sales more heavily. But just talk about that cycle. I mean, we all know in real estate there are lots of up and down cycles. And what's actually interesting for me is, I came in 2008, so I had never seen a up cycle until the past 18 months or so. Not that it was ever that bad in Texas compared to other markets, but it's a very different market right now as we sit here in kind of mid 2015. I had to think about what year it was. Mid 2015 compared to 2008, 7 years ago. It's a very different market right now than it was then. And there's I can see it in myself. There's a lot of kind of learnings of going through cycles to see, maybe I need to sit on the sidelines for a while and wait for this to happen again, or this has opened up some new door. I think that's pretty common for real estate investors to kind of ride cycles up and down. Of course, the key is to ride them the right way, right?
Right, and you have to adjust.
Yeah.
You have to adjust to the cycles.
Yeah.
It's really very funny right now, Mike, because this reminds me very much about 2007 and 8, where there's like a frenzy atmosphere. And everybody and his brother is getting into real estate, and it's very fashionable. 2009, 10, 11, it wasn't.
Right.
And now, all you coming out of the woodwork are all these pie in the sky guys on the internet.
Yeah.
And I don't need to condemn everyone, but you see a lot of these guys that their only experience is selling the books and tapes, and they haven't really done it. And you see a lot of that. And unfortunately, a lot of people are paying a lot of money, and they're selling courses you can buy, and you can't do them here. So that's the kind of, which sort of leads into, there's a big difference, a big economy in the states. Out of our 50 states, about half of them are what we call tax lien states, and the other half are tax deed states. In a tax lien state, when you buy at the auction, what you're buying is the actual amount. It's a note. It's the debt that is owed. If you owe $8,000 in taxes, that's what you're bidding on. Is I'll take less interest rate than the next guy. The guy who'll take the lowest interest rate, he gets that note. Then if the guy defaults, then he has to start a whole foreclosure process.
Yeah.
In Texas, it's what we call a tax deed state. When you buy the property at the auction, you get the property. You get ownership. You're entitled to the right of possession, the right of collect rent, all of it. The owner who lost the property has no rights anymore, except for the right to redeem it.
And you said tax deeds are about half the states, is that right?
Roughly half are tax deeds.
Okay. So a tax lien, just to clarify, a tax lien, you're buying that lien. that they're going to owe you instead of owing the city, and the city is selling it to you at a discount because they want to get something for it, right?
Well, they'll
Or the
start
municipality or whatever it may be. Yeah.
yes, yeah, and they'll start the bidding up. Okay, by law we can charge 18%, and somebody will say, "I'll take it 18%." The next guy will say, "I'll take it for 16." The next guy, "I'll take it for 12." Now, if you get some big funds out there that want to get in the market, they can take it for 1 and blow everybody away.
Yeah.
So that's
so with tax deeds, you're actually getting the property, and then every state is a little bit different in terms of the way redemptions work, right? So talk about what a redemption. I mean, kind of pretend like we don't know what that is, and tell us what that is.
Yeah, in Texas, the right of redemption is that the person who lost the house and anyone who had an interest in that property, including the mortgage company, has the right to redeem it. And that right to redeem it is for 180 days, unless it's a homestead or has an agricultural exemption or is a freestanding mineral right. Then it's 2 years.
Okay.
2 years. Now, the homestead is not just whether or not they have a homestead exemption. It's whether they were living in the house as their primary residence when the suit was filed. And that's sort of a technical thing that came about by case law. But the reality is it really doesn't matter whether it's 6 months or 2 years, because most investors are unable to get a title policy for 2 years, even with the 6-month redemption. Because there's another law in the books that says someone who wasn't notified properly can contest the sale for up to 2 years. And although it almost never happens, the title companies are going to hang their hat on that. And
sure.
They're very reluctant to get title policies prior to 2 years.
Right.
Therefore, in our opinion, what you should do is, in Texas, you buy the property as if you have to keep it for 2 years. And so you want to have cash flow. So you should not buy it for the right of redemption. And by the way, the frequency of redemptions, that's another difference between the tax lien states and the tax deed states. In tax lien states, you're talking about smaller amounts of notes, and most of those do get redeemed, maybe even as high as 90% of them.
Wow, okay.
And it's the exact opposite in tax deed states. Statewide in Texas, about 10% of them get redeemed. Now, our average happens to be 20 because we don't buy vacant lots, which almost never get redeemed. It brings your average down.
Right, right.
But still, 1 in 5 is not a reason to go buy a house. I mean, that's 200 batting average, and that won't make it in the majors. And
right.
This is the major league, you know.
Yeah.
So our opinion is you buy it for cash flow. If it gets redeemed, it's a home run. But meanwhile, you've got good, solid cash flow.
So the key is with in a tax deed state like Texas, for example, is you want to be able to buy a property that you just kind of have to wait out that redemption period. Do you typically would you know at the time you buy it if there's a homestead exemption on that person that might redeem it? So do you know if your redemption period is 6 months versus 2 years, or?
You really don't. There's no rule of thumb. But as I said before, it doesn't matter. You can't sell it for 2 years in most cases anyway.
Right, right.
So, it's just, if it does have a mortgage on it, we found it's more likely to be redeemed. But that makes sense because the mortgage company may own 80% of it and you own 20% of it, and they have more skin in the game. They have more to lose. So they are more likely to redeem it if there is a mortgage on the house.
I see. So typically, one of the, I think, myths, because I think you've told me differently before, is that people who are living in their house go to tax sale are just in the lowest dollar areas of town, in the hood, if you will, because the houses are, probably not worth a whole lot anyway. But kind of explain that.
Well, actually, you remembered part of it.
That's the story of my life, Arnie. I always remember a part of something, but never the whole thing. So it's a two-tier system. There are the lower priced houses that you're talking about, and then the higher price. Now, there are more of them in the smaller areas. And in those, you probably never will be able to fully get a retail price for them because generally the people in the lower price houses, they can't qualify for a loan 2 years from now. And if they could, who's going to loan them a $30,000, give them a $30,000 mortgage? Right.
So it's less likely. So in those, you should really go for a higher percentage cash flow. If you do need to sell at some point, you can sell it to another investor, and they're just going to look at cash flow.
Yeah.
Now, of course, you could do owner finance on it also, and perhaps do well. And the higher end, and those are the ones that everybody loves, because you not only have good cash flow, but you have a great potential for a capital gain 2 years later, especially if you're buying at a discount and even without any appreciation.
Right.
But when you have the discount and the appreciation and the cash flow while you're waiting, it's really highly.
Sure. So how do you, there's always, I guess, probably a fear of people that might get the house redeemed. Of course, there's a good return on it if it happens, but talk about the situation of, because the name of the game is you want to try to not put a lot of money into the house to redeem that, right? Or can you get reimbursed on improvements to the house?
Well, good question, Mike. And I should have brought this up earlier. The way it works is if they should redeem it, they have to pay you back all the money that you bought it for and some other funds that fall under the three magic words, anything to maintain, preserve, or safekeep the property. Well, that would include insurance costs. That would include fixing up anything wrong. You know, if the carpet's worn out, you replace the carpet. If there's a hole in the roof, you fix it. What it doesn't include are upgrades.
Okay.
But anything you put into the house to make it, to maintain, preserve, or safekeep, and as what? As a rent house, that's going to be okay.
Right.
So very often, we had one case not long ago where one of our investors had a house for $8,500. He bought it, and he was all in for $8,500 and had it rented for $500 a month to the owner, who redeemed it a year and a half later for $20,000.
Wow.
So it wasn't just his $8,500. It was all the insurance he paid since then, some of the fix-up expense and all that. And plus, in the second year, it was 50% over and above. See, I probably forgot to mention that. You get all your money back plus 25% in Texas if it's the redemptions in the first 12 months, and 50% if it's in the second 12.
Okay.
And that's not prorated. So if it's 1 year and 1 day, it's 50%.
Oh, wow.
Yeah. So it's
so in other tax deed states, is that similar, or is Texas unique in that regard?
There are similarities. Texas has the highest. 25% is the highest. 25% first year and 50%. And most of them are not prorated. And in some states, even though they have a 20% redemption rate, for that first year, you can't make improvements and you can't collect rent. So,
oh, wow.
Yeah. Texas is very, very friendly, investor friendly in the tax scene.
Sure. Well, talk a little bit about, we kind of talked about why Texas, so that makes sense. But talk a little about what keeps people from moving into this space. I know that you said that some people, just don't want to do the work. There's a lot of little things to know. But what keeps people out of this space? What are some of the kind of typical things that keep people from getting started in this space?
Well, first of all, you can't go look at the house that you're going to buy.
Right.
If it's occupied, because it's trespassing. And, this is Texas. If your house is on the list and 50 people keep coming up to your door and ringing the doorbell and saying, hey, your house is going to go on the sale block, can we come look at the house? This is Texas. How many times does that have to happen before you come to the door with a shotgun? I mean, so you're not supposed to do that. There are people who do it.
Yeah.
But you're not supposed to do it, number one. So it's difficult if you can't get in the house, it's difficult to estimate what's it going to cost to fix it up, to rehab it if it needs it.
Right.
So that's a tough deal there. And there are other due diligence things that you really have to do. For example, if there are mortgages on it, great, it gets wiped out. But not every lien on there gets erased. Government liens do not get erased. So you have to do a little research to find out, if there's some liens on there and In addition to that, there are post-judgment taxes. In other words, if you go to a foreclosure sale for the trustee where a mortgage company is doing the foreclosing, you stop making your mortgage payments, they can foreclose right away. That's not true about taxes. They have an obligation by law, statutory. It's a judicial process. They have to notify you, and then they have to notify everyone who has an interest in that house. And then they have to get a judge and set up a court date and get the judgment. And that can take a period of time. And once you do that and you get that judgment, it may now take anywhere from 6 months to 6 years to find all the heirs and everybody who has an interest in this, to notify them that it's going to go to sale on the tax sale. During that time, the taxes don't stop. But the judgment was as of that date. So all those accrued taxes since the judgment date are inherited by the buyer at the tax sale. And they don't tell you how much that is. You have to do your own research to find out if it's there and how much and all that. We call those post-judgment taxes.
Wow, yeah.
So there's so many little nuances and things like that and there's nowhere to go to learn these things. There's no school that teaches you. Now, we have meetup groups and we have classes, and it's open to everyone. We don't even charge for it because we want people to know. In fact, it's interesting too because the property taxes pay for half of what's collected in statewide property taxes goes to public education. Oh, wow. The rest of it goes to police, fire departments, all these essential things. And so I say it's our civic duty to go buy these properties at the tax sale. So we have the tax revenues and they don't have to raise our taxes.
There you go.
So that's my banner.
Yeah, yeah. And talk about specifically in Texas, Arnie, when the sales occur, because they're at the county level, right? And they're all pretty much the same day. State, right?
There are 254 counties in Texas. If any of them are going to have a sale in a given month, they all have to be on the same day, the first Tuesday of the month. Now, the reality is this. In a given month, anywhere from 40 to 60 counties will have a sale. Not all of them.
Okay.
There's some counties in West Texas don't have as many people that are on this call.
Right.
So they don't have very often. But even some of the bigger cities. Now, your 5 biggest, the Dallas, the Houston areas, and San Antonio and Austin and Fort Worth, those are the 5 biggest cities, and their counties have sales every month. Sure. But even the county that Waco is in is every other month. And the county that Abilene is in is every 3 months. Okay. So in any given month, there are 40 or 50 or 60 counties. And we cover them all, by the way. Yeah, yeah. Because, that's what it's all about.
Yeah, and I think that's a challenge that some investors face. I know with not with tax auctions necessarily, but even foreclosure auctions, is that, for those that invest in the Dallas-Fort Worth area, for example, there's 4 main counties, and the sales are all happening at the same time, and there's multiple trustees. So in order to cover all those sales, you have to have an 8 or 10 person team that's effectively watching the auctions in all those locations at the same time and covering multiple trustees. So that's some of the challenge I think that keeps people away, is just the ability to be in more than one place at once to kind of see what's going on. Is that the same for tax auctions as well?
It's absolutely true, and it's a great segue because we had the same problem. Now that we have the internet, we can look at the properties in all these different counties, and how do we get to them at the same time? Because you have to have the money right then at the sale. Yeah. So we invented something called the Learn and Earn program. We have investors who want to learn about the tax sales, and so we teach them. And one of the things we teach them is to go to the sales for us, to represent us. And if we buy a house that they're involved in, we pay them for doing that. Wow. And so that's how we're able to be in 10 to 15 to 20 counties on a given
all at the same time
of every month. Yeah.
Yeah. That's great. Well, Arnie, if folks want to, I know you're kind of the authority for Texas tax sales. If they want to learn more about investing in Texas tax sales, where do they go?
Well, our website has a lot of information on it, including the story of how we got started and what we've done, what we've progressed. And it's very simple. It's TX, just like Texas abbreviation,
Yep.
txtaxsales.com.
Oh, that's very easy.
www.txtaxsales.com. And it's a very friendly website with a lot of information. Anybody can call me or email me. My email address is arnie@txtaxsales.com. Now, I'm happy to get emails. I get them all the time.
Okay, awesome.
Yeah.
We'll add the links and your email address even down below here for those that are interested in learning more about Texas tax sales with the sheriff, Arnie Abramson. Arnie, good to see you, my friend. Thanks for your time today.
Can I make one last comment?
Sure.
This not really, just so you know, our program is completely turnkey. We have investors from in Texas, out of the United States, out of the continent,
Yep.
From all over the world. We have investors. So, and so go to the go to the website and learn as much as you can. If you have questions, we're happy to help.
Awesome. So you don't have to be in Texas to benefit from investing in tax sales in Texas. Good thing.
You know what? That's a great topic for a seminar. You don't have to be in Texas to profit from Texas.
There you go. There you go.
Great.
I'm a burgeoning copywriter, Arnie.
There you go.
All right, my friend. Have a great day.
Thank you for having me.
We'll see you. Good to see you. Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry, so get on over to FlipNerd.com.